You're watching News 9. I'm Shweta Kothari. We're bringing you stories from the world of business, policy and economy. To my left is my colleague Suyash Maheshwari. Suyash, good morning.
Good morning, Shweta.
What's happening with markets this morning? So
markets, after seeing a 1% correction on the back of, monthly FNO expiry, bounced back, and this was amid a broader uptick in the global equities. Now, US markets saw about a 0.5% rise yesterday. European markets also closed higher. Asian markets were also trading mixed this morning. Now, this is on the back of a trifecta effect where we have seen crude prices easing. Now, if you remember, yesterday Brent was edging towards a $98 a barrel mark. WTI was near the $93 a barrel mark. Crude prices have eased since last night. The dollar index has also eased. It has come off from its 1-year high, and we are also seeing the yields coming off the 16-year high. So all three factors have boded well for the global equities, and as a result we are seeing an uptick across the board. And Indian markets also had that rub-off effect where markets opened higher. They were up about 0.2 to 0.3% this morning. As you can see, at 9:40 a.m. this morning, Sensex was up 0.21% at 65,640 mark, whereas Nifty gained 0.21% as well, and it was up around 19,564 mark. Now, the broader market, Shweta, are also participating in the rally. They have been participating, rather they have been outperforming for the most of the sessions in the last few months or so. They were also trading with gains of about half a percent. India VIX, the fear index, which spiked up about 11% or so yesterday, eased by about 6% this morning, but it also sits above the 12 mark, which indicates that the volatility is still higher in the market compared to the last 30 days or so. Now, among sectors, all sectors were trading with moderate gains this morning, but IT pack, Shweta, IT pack witnessed some selling pressure. It was the only sector that was down this morning. IT pack was down about 1% on the back of a muted guidance coming in from Accenture. Now, the expectation is that FY24 revenue growth won't be as as the order books were suggesting, and it will continue to remain muted, given that the discretionary spending is still under pressure, and BFSI segment has not really responded too well. As a result, a lot of these IT bellwether stocks were trading down this morning with a losses of about 1 to 2%. Among the gainers, among the gaining sectors was pharma and PSU banks. Pharma index, which was also came under pressure yesterday, bounced back and was up about 1% this morning. PSU banking stocks continue to outperform, both the market and the private banking pack. They were once again, in the green column and leading the way. At that, it was up about 1% or so this morning. So that's pretty much a roundup of how morning trade is looking like. All right, lovely for summing that up for us. Kranthi Bathini of Wealth Mill Securities joining us on the show. Kranthi, good morning. Good to have you back on the show. I want to begin by asking perhaps a question that's weighing on in every person's mind. Is the much needed consolidation phase now over? Are the markets only going to inch up from here on, given that a lot of factors are working positively for the global markets, and that has a rub-off impact, as my colleague was pointing out, on Indian markets?
Absolutely, Shweta. We are in a consolidation phase, and of course, there are looming fears of crude and also rising US bond yields. These were the factors impacting the market. But the market is waiting for a reason to consolidate. That's what I can see. Before the earnings season that's going to kickstart in the coming weeks, so we can see the markets are in a consolidation phase right now. Now, the key drivers for the market will be the earnings and guidance of the companies, definitely going to lead the market. We can see the consolidation phase might take another couple of weeks. That's what I can see as we are getting into a new month right now. So the consolidation phase, we can say it might take a couple of weeks time. But Shweta, one thing, last 4 or 5 quarters, if you see the market tendency, whenever markets get into a consolidation phase or a correction phase, the investors who have the strength and braveness to invest in Indian markets, they are completely rewarded in Indian markets. So I believe the same kind of trend is going to continue. The macro setup is strong at this point of time. We are in a strong bull market, but in these bull markets, we do have these kind of small blips and consolidations. So nothing to carried away. There are some global factors, lingering global factors are impacting the market here and there, but Indian market still offers a very good growth prospects for the investors who are looking to invest for a medium to long term.
Now, to Kranthi's point, Shweta, the recent correction, we have seen that the markets have fallen about 700 points or so in the span of 6-7 days. But if you look at the month-to-date returns, the markets, if we can recall, go back to the first or couple weeks where the market scaled, 20 record levels of 20,200 or so. The markets had run up about 950 to 1,000 points, and now it has corrected about 700 points. So on a month-to-date basis, we are still up about 250 basis points. So as Kranthi was saying, the overall trend does look bullish. However, there are some global headwinds. And talking about global headwinds, Kranthi, everything seems to be rather, tilted towards the global side. We have been talking about crude prices hovering near the $95-96 a mark for quite a while now. The bond yields have been elevated for the last month or so. The dollar index has been also a pain point. I mean, at this point, investors or traders would expect that all these factors have been priced in, wouldn't you say?
Suyash, the beauty of this market is what is certain in the market is every day when we wake up and look at the picture of the market, there is something to worry about in the market every day. So there it might be the domestic or it can be the global factors that keep on causing a concern or worry to the investors. If you see on a day-to-day basis, to bring to your point in the perspective. The Indian markets have been outperforming in the emerging market space. And also, if you observe the trend of the market, the S&P 500 is 3 months low, whereas Indian market is on a sustainable basis, we are up. So, some kind of much needed consolidation that's taken place in the market right now, which is healthy for the market setup. Otherwise, it's not a random walk theory. It can be called as a vertical move in the market.
Sure, Kranthi. Any domestic cues that are worrying you at this point in time?
We need to see, because crude has just started inching. So how the inflation is going to be, and monsoon has been uneven. Some parts of the pockets, it is excess monsoon. Somewhere, some kind of areas, there is a deficit. So the food prices have been cooling off right now at this point of time. But we need to wait and watch a couple of weeks to get the complete clarity about the inflation picture is concerned. So this is one of the worrying factor at this point of time. So if the inflation cools, we can expect much anticipated rate cut, which is right now it's not possible in the near future. So if the inflation cools, it can give at least 1 quarter advance of rate cut we can see, where RBI can be comfortable with respect to the liquidity and inflation position in India is concerned. That's where I'm looking forward at this point of time, Suyash.
Okay, so if inflation continues to cool off, when are we looking at a rate cut?
Probably market was anticipating a rate cut earlier in the month of December or Jan. But given the condition of recent hike in the inflation, we don't expect in this financial year a rate cut. Probably a rate path can be continued. But we need to look forward for the financial year FY24. That's where a rate cut can be possible. If the inflation can be continuous looming upwards, then the global and the current indication says rate cut in FY24 is not possible. That's where the cause of concern at this point of time, Shweta.
All right.
Also, Kranthi, let's talk about the broader markets now. I mean, both mid-cap and the small-cap indices have continuously outperformed the market, at least in this financial year. But now we are seeing some sort of divergence also playing out between the mid-caps and the small-caps. Now, mid-caps returns have moderated, rather they have been in line with the large caps, but small-cap indices have, like small-cap stocks have continuously outperformed the market in the last couple of weeks. And even if we look at the index as a whole, the number of stocks that were participating, I'm talking about mid-cap, have reduced significantly in the span of 1 month or so. Are you also looking at this divergence? Is it something that is playing out, and can perhaps time to look for some value in small caps? I know it's hard to find, but maybe mid-cap rally has consolidated.
Suyash, you rightly pointed out. The reason for this is it's quite natural in the bull market rallies. Those who understand the trends and observe the trends of the bull market, normally when the market setup is quite strong and the sentiment and the liquidity is quite strong in the market, what happens is the money tend to chase after chasing the large cap. Then the money flows obviously get into mid and small cap space. So right now, it's after the rally. Right now, what we are witnessing is it is more about a stock specific action that's taking place in both and mid and small cap space. So the market tend to the liquidity tend to getting into the names where there is some kind of value. But here, when you say value, there is a misconception. Okay, people tend to get into penny stocks. People get and there is a factor have been playing that is called two-digit factor in the market. So the normally retail investors tend to see what are the stock that is on two-digit or single-digit. They tend to see value. It's not the price they should see, but valuing, looking the value in a valuation perspective is certainly important for the investors. That's where the investors get trapped into these kind of what we can say is value traps rather than value investing. That's where investors need to cautious. But one point I would like to ponder upon everyone is the Indian market strength is quite strong. Normally, what happens is if you observe the trends in 2004 or 2007 or 2011 or 12 or 14 or 17, what was happening was the leverage to market ratio, okay, was that represents the froth in the market. So that was on a relative basis, it was very high. But due to the measures that's taken by the regulators, SEBI and the exchanges in the recent past, so the froth and the leverage in the market is right now is completely negligible. And also what we can see is the recent surveillance measures taken by the exchanges. So these are like a speed breakers when a stock has been going up out of the reach, out of the limits, and the stock have a froth. These are the measures, the surveillance measures taken by the exchanges have taken a complete, we can say, controlling of the speed and pace of the market. So that's where the confidence is coming back, and also the liquidity is sustaining, making the market to sustain. So, that is the positive of the positive nature of the market that is sustaining the Indian markets at a high basis.
Now, Kranthi, the earnings season is also upon us. We'll in the next couple of weeks, the Q2 report card of India Inc. will start pouring in. What are your broader expectations from the earnings season, and what will be, some of the sectors that will outperform and underperform as well?
Yeah, the sectors. One thing is clear, Suyash. We need to see how the increase of raw material prices or inflation is going to have impact on the earnings of the company, and also the sales numbers have been quite robust given the kind of the economy has went up. So we need to see how the impact of inflation, and just to look into the factors. Okay, the industries, we need to look into the banking and financial services, how the numbers are going to play, and auto, the stocks, the sector has been robust in the past 2 quarters. So auto sector is going to be the numbers, and results we are looking forward. And the engineering and construction and infra capital goods, these are the spaces where we're looking forward for positive setup in the Q2 quarter is concerned with respect to the results card is concerned.
All right. Before you take up a question, I think I also quickly want to understand from you. You know, we since we continue to track all the global cues, and before we come back to the domestic cues, I want to understand as far as inflation is concerned, and we keep tracking about inflation, but oil prices, when is that likely to show up and have an impact on Indian consumers as well as Indian equities market? We know consumers maybe not likely, but the larger impact of oil prices not stabilizing, and especially in the light of the new upcoming news items that there could be a further cut in oil production, how's that likely to play up as far as global prices of crude is concerned, inching towards $100 mark anytime soon?
Yeah, Shweta, the crude oil has been rallying, but what we can expect is crude oil prices have been peaked off certainly at a peak price at this point of time. The crude oil can sustain. It may touch $100 per barrel, but what is my view is it cannot sustain above this $100 per barrel. What we can see is crude oil can be in a range bound in the coming future. But the reasons for if the crude oil has been going up, it gives two types of understanding theories it will throw for the investors. One thing is the global economy is so strong, the energy demand has been so robust. That means it can create an inflationary environment for a period of time. Whereas right now what we can see is, as you rightly mentioned, it's more about the supply side rather than the demand side is concerned. So right now, on a longer term basis, the crude oil prices can be below $100 per barrel. But if the crude oil can, if it sustains above $100 per barrel, it on a longer term basis, it can create some kind of pressure on economies like India in terms of the inflationary environment. But coming to the global setup also, if the crude oil prices are on a higher note, economy like US also, it will be double whammy for US. So we need to clearly observe how this trend is going to be. But my personal opinion at this point of time is I don't see crude oil prices sustaining about $100 per barrel. I can see the crude oil prices are peaked at this point of time. Probably plus or minus 5%. It can touch $100 in the short term, but on a longer to medium term basis, I don't expect until unless there is a geopolitical environment which is going to create some kind of disruption in supply chain management. I don't expect a sustained high crude oil prices in a medium to longer term basis.
All right.
Now, Kranthi, before we move on to stocks, I also want to quickly get your view on the IT pack. Now, the IT pack is the only sector that is trading with losses. In fact, it was the Nifty IT pack was down about 1% this morning, whereas all other sectoral indices were trading with moderate gains. Now, I think one of the reasons why the IT pack came under pressure was on the back of Accenture's muted guidance. Now, do you expect, given that Accenture is not really bullish about the revenue guidance, in the upcoming quarters, do you expect the Indian IT companies to sing the same tune once the Q2 season rolls around?
Suresh, the point you mentioned is absolutely right. But here there is a catch and divergence is right there. We can, what we have witnessed in the previous quarter was there is some kind of delivery-based buying, what we witnessed in Indian IT names like Infosys, TCS and other companies. But the point to ponder here is when we interact with the mid and small cap IT companies, they are quite bullish and quite robust in terms of their earnings are concerned. Of course, the large cap companies, the big 4 or 5 IT companies, they have been expressing their concerns with respect to the global growth prospects and US economy. There are some kind of concerns, and gaining the billion-dollar orders, there was some concern. Whereas with respect to the mid and small cap companies, where they operate in a single domain and concentrated in certain geographies, they are quite bullish with respect to their with respect to their earning prospects. And in fact, what they're witnessing in these kind of uncertain days also, some kind of margin expansion, and also winning the orders, increasing the orders. So there is a certain element of divergence between the mid and large cap IT space. But on a longer term basis, probably it can create the essential guidance and all. It can create some kind of knee-jerk reactions in the market with respect to IT is concerned. But if I have to think about investing in IT in a perspective of 5 to 10 years perspective, definitely, if there is any drift, if there is any correction in the valuations, for a longer term perspective, definitely IT offers a good value buy for the investors only for a pure longer term perspective.
All right, and we'll get more clarity as the earnings seasons begin. But let's move on to some of the stocks that we are tracking, Suyash.
Yes, Shweta. So MCX, the news regarding MCX just came out and the stock is down about 8%. Now, the reason why the stock is down 8% is that SEBI has asked the MCX to put its planned launch of its new platform, which was scheduled to roll out on October 3, on hold for now. As a result, the stock corrected about 8% or so. Now the planned launch, the shift to the new commodity platform was expected to significantly reduce the cost for MCX, as its previous service provider, which was 63 Moons, the contract, over the extension of the contract over the last year has cost the company about 470 crore rupees or so. And the margins had come under pressure, and there was a variable portion also which was giving a lot of investors concerns. Now MCX is going to shift to a new provider in TCS, and there is the cost is fixed, so the cost component is expected to significantly come down, and as a result we had seen a significant run up in MCX's stock, and it was up about 20%. However, the decision by SEBI to put the launch on hold.
What's the rationale behind the decision? What is the reason given by SEBI?
I think the news just came out. SEBI, from what I'm
so
reading,
there's not much clarity.
There's not much clarity as of right now. Maybe through the day we'll probably talk about in the afternoon show. But as of now, it seems that MCX's launch and the shift to new platform is on hold. It won't be launched or moved to the new platform on 3rd of October. And I think we are seeing the reaction of the market to the news, and the stock is down about 8% or so.
All right, let's get Kranthi in. Kranthi, any reasons that you can think of for MCX new platform not getting a go ahead from SEBI just as yet?
Shweta, the stock has run up in the recent past, recent week. There is a sharp uptick in the stock price is concerned due to the expectation of the new launches and the recent tie-up with TCS as a new service provider for them. So SEBI have some kind of right now they have the stringent measures, so that might created the pressure on the stock. But on a medium to long term perspective, this is the stock to watch going ahead with the recent developments that are taking place in MCX is concerned.
All right, and you're also tracking Adani Energy, Adani Power today, Adani Green, I beg your pardon?
Yes, so Abu Dhabi's IHC is looking to offload, its stake in two Adani companies, which is Adani Green and Adani Energy Solutions. Now, we don't know what the details of that transaction is going to look like, but at least from what I'm reading, that it has landed a buyer for the stake sale, although it has not revealed at what price it will sell the stake and to whom it will sell the stake. Now, IHC was one of the marquee investors that had been investing in Adani group of companies back in 2022. They pumped in about $2 billion in 3 Adani group companies, including Adani Energy and Adani Green. Adani Enterprise was another one. They even were participating in the FPO which Adani Enterprise was going to launch. However, it was scrapped, as we know. So I think it was a major dampener for the stock, and as a result we saw about a 1% or so correction in both the counters today. And it looks like, if you look at the year-to-date returns or the returns that both the stocks have given since the Hindenburg report came out, they are still about 50% or so down from the price levels, back in January. So, and now the recovery has also not been that strong.
All right, the recovery is not strong. Kranthi, what's the rationale behind IHC diluting its stake in Adani Energy and Adani Green?
Yeah.
Is it not seeing the same value in the two companies as it did back in 2014 and 15?
Shweta, one thing here is they could able to find a buyer to exit. So it is one man gain is the other man loss. So we don't know the reason for IHC because they were quite active with respect to the Adani's rights issue. Also, they were quite active in Adani Enterprises rights issue. They were one of the key subscribers. So for the issue, we don't know the exact factors. What led them to exit from these investments. But one good thing is they are not going to dump the stock in the open market. They could able to do a negotiated deal. But we don't know the buyer at this point of time. So just wait and watch how the developments that are going to take place in Adani Group is concerned.
Now, Kranthi, you said that it will be someone's loss and someone's gain. Who is the loser here, IHC or the buyer?
So definitely. If the stock rises after this transaction, IHC will be the loser.
I mean, it's still down 50% from January levels, no? So do you expect some sort of pullback, given that SEBI's decision also is expected to come out in the next couple of weeks or so?
I'm assuming you're calling IHC the loser here. That is my assumption, or is it the winner?
Yeah, well, we need to we need to give some time to determine who is the winner and who is the loser.
Okay.
But the point I am going to mention here is the group nature. The stocks are high beta always in nature. So the people who like this kind of volatility, who likes this kind of movements, high beta nature, Adani Group stocks are suitable. It's not for the people who don't want the volatility. Whenever any investor picks up stocks in Adani Group, they need to embrace the volatility and nature of the market. They need to prepare.
All right. It looks like we've lost Kranthi for now, but Happiest Minds is also in news.
Yes, Shweta. So Happiest Minds, the stock was down this morning. Now this was on the back of Mr. Ashok Soota, who's the executive chairman of the group, paring his stake. He sold about 1.11% stake in the IT company. Now, if you look at the the details of the trade, he has sold about 17 lakh shares at 879 rupees, which was at a discount to yesterday's closing price. Now, Soota's holding has come down after the stake sale to about 50.13% from 51.24% as of June. And now, Mr. Soota said that the transaction was primarily done to fund the capital requirements of SKAN, which is a non-profit medical research floated by him, and also to boost the capital base of Happiest Health. Beg my pardon. And Mr. Soota also said that despite the stake sale, investors need not worry much, because at no point in time he'll reduce his stake beyond 40%, but there is still a 10% gap. Kranthi is back. Good to have Kranthi back. Kranthi, the stock was all everyone could talk about 2 years back in 21 after the IPO came out. However, the returns have moderated largely. MCX stocks has not done pretty well in the last 6 months or so. What's your take on the stock?
Yeah, sure. So you are absolutely correct. After the initial euphoria and exuberance of Happiest Minds is concerned, the stock was an underperformer. Post listing, it rallied for a quarter, and later on the stock has drifted when compared to its peers. So there are some concerns about the aging of the promoter. They are going to address they are going to bring the professional management in picture at this point of time. But I can see some kind of value in this stock given the kind of the domain they operate. Once there is a clarity that emerges with respect to the succession planning of Mr. Soota and all, that will help the stock to get some kind of buying interest. So the clarity market is waiting at this point of time. The succession plan and strengthening of the board, that's extremely crucial for happiest minds is concerned, which is a lingering impact in the medium to short term. As there is some kind of concern with respect to the IT stocks are concerned. So the stocks which have some kind of this kind of lingering impacts, the stock is getting impacted due to this reason.
All right, and before I let you go, it's important, pertinent to discuss Chola Investments because it's trending, one of the top trends this morning.
So Cholamandalam Investment is, looking to raise 2,000 crores via QIP, which is called Qualified Institutional Placement. Now this QIP is part of a total fundraise of about 4,000 crore that the company's board had approved back in August. Now for this QIP, the price has been set at about 1,180 rupees, which is a 3% discount to yesterday's closing. And in fact, if you look at the entire NBFC story, Shweta, a lot of these NBFCs have been recapitalizing or bolstering their balance sheets, as of late. A couple of days before, Aditya Birla Capital pumped in about 750 crores or so in Aditya Birla Finance. Bajaj Finance, whose shareholders will meet on October 5th, are looking to raise, at least as per the reports, somewhere around $1 billion or so. So it seems like, the competition that is expected to intensify with the entry of Jio Finance has put some, put these companies, under pressure, and also they are, kind of bolstering their war chest. They are building that war chest, sort of bolstering their balance sheet, improving their overall return ratios and all, in expectation that, Jio Financial Services could play a major disruptor for the industry.
Okay, looks like NBFC space is on a major war footing. All of them prepared and geared up for Jio Financial's entry. We'll keep tracking those updates. Kranthi Bathini, thank you very much for joining in this morning. Suyash, to you as well. Thank you, gentlemen, for your time. But on to our much anticipated show at 10 p.m. today, Duologue. TV9 MD and CEO Barun Das in a candid conversation with renowned cardiac surgeon Dr. Devi Shetty.
When a patient's mother touches my feet, begging to save her child's life, I don't feel empowered. I feel humiliated.
To normal people, the doctor is somewhere in between us and the God.
I'm just an instrument in the hands of God.
What you have initiated in making healthcare affordable to Indians.
India will become the first country in the world to dissociate healthcare from affluence.
To do the right thing, there's only one reason needed, which is intent.
We are pieces to solve all the problems. Someone has to put it together. This is the story of India.
Duologue with Barun Das featuring Dr. Devi Shetty. World premiere on Connected TV. Tonight at 10. Only on Newsline Live. India's first and only digital exclusive English news stream for Connected TV. Powered by Tata 1MG Labs. Supported by Alliance Broadband.
All right, you can watch that interview at 10 p.m. tonight. But moving on, NSE has added 1 crore new investors in a very short span of time. What does it really mean? Karthik joining us in the newsroom. Karthik, what does it mean?
Hi, Shweta. Nice to have you back with us after a hiatus of almost a week or so. So good to have you back. Yes, NSE. So I think, the war footing is not just Cholamandalam. The war footing is actually even NSE. NSE has been attracting investors pretty much at war footing. So 1 crore new investors added in the last 8 months alone. Now this takes the total number of unique registrations of investors at the NSE at 8 crore. So 8 crore unique individuals, retail investors, are actively participating, investing via the NSE platform. Now, what do these 8 crore Indians really represent? These 8 crore unique registrations represent about 5% of the total 17% of the total households of the country, 5 crore total households, which is 17% of the total households. So I think the signal is fairly clear that as a country of savers, we are now very, very seamlessly migrating into becoming a country of investors. Now, why is this happening and where is this happening from? I think important to put that in perspective. If you look at the north, south, east, west divide in the country, North India continues to be the largest chunk contributing to these new 1 crore investors, about 43% of new investors coming from North India, followed by West, followed by South, and the East continuing to be a laggard. So not a great story there when it comes to investments coming from the eastern part of India into stock markets, but North India continuing to dominate. Within this, what is the city-wise cluster, the city that we guys are living in and Suyash talks about every day from a market's perspective? Delhi NCR, the biggest contributor, 7% of new registrations from Delhi NCR, followed by Mumbai, followed by Pune. These are the top 3 cities. But I think the narrative also emerging is that from these new 1 crore investors, about 45%, more, a little less than half the total investors are not from the top tier metros.
Okay.
So while Delhi contributes, Mumbai contributes, Pune contributes in high percentage figures, almost half of these new investors, about 45 lakh new investors registered on NSE, are not from the top tier cities. They are in fact from tier 2, tier 3 cities. And that is really bolstering this whole move from a country of savers to a country of investors.
Okay. You know, what's surprising there for me is that Delhi NCR, in fact, Suyash, is it's the top, you know, tier 1 city from where most investors are investing, hopefully are also actively investing. 7% in Delhi to about 4.6% in Mumbai. What does that tell you? I mean, people would generally expect Mumbaikars or Maharashtrians in general to invest more because that's the financial
Or Gujaratis
capital.
for that matter. You know, I think
Yeah, and Gujarat for
Gujarat
that matter.
leads stock markets, and here we are seeing a completely reverse trend.
I mean, the only thing that I can pick out is that increased participation. That has been the theme. And you know, 17% of the households are now investing in the markets. Is a huge deal for the markets. And we have seen this boom come, you know, right after the COVID pandemic happened. And a lot of retail participation also picked up. And in the last 2 years, we have seen the markets, the participants have been largely resilient. You know, they have seen a war breaking out, economic turmoil brewing, you know, geopolitical tensions also are there. They have been largely resilient, and they have not, after the COVID crash, we have not seen a big crash in the markets. So retail participation has improved. They are, it seems like the investors are getting more, you know, well versed with the markets because of the, you know, fintech improvement in the ease of transactions,
ease of participating in the markets. But you know, I think at some level, Shweta, it's also a story about investors really seeing robust returns over the last 3 years.
I was about to come to that.
The Nifty 50 has returned about 22.5% to investors. The Nifty 500 has returned about 25% to investors.
So the fact that you're getting better returns,
period.
Right?
Better returns. I mean, you know, you don't want to leave your money in a fixed deposit, which is just about
7%.
Actually, post-tax, not even beating inflation. So you see an instrument, or you see an avenue open where you can be returned much more handsomely than what traditional banking instruments do. And I think that education, that realization is finally setting in, and we are seeing this tectonic shift that money is not going to be lying in banks. In fact, you know, the other day there were also stories, and we also discussed, Shweta, that there were stories about the household savings declining. Now, you know, juxtapose this data coming with household savings declining, why not? Household savings declining and investments increasing. So I think it's a very happy situation.
You know, at this point, the only anomaly that perhaps comes to my mind, and if whether it's an anomaly at all or not, taxpayers in India, about 7 crores, investors about 8 crores. I mean, what is the variation here? How do we count for this? So there are 1 crore people who are not paying taxes but are investing.
They have done their KYC, they have their PAN registered, they have their Aadhaar registered, they have and they are representing unique households of about 5 CR. So I think what it is also telling me is, reading between the lines, that
how do you read this?
We are perhaps looking at more number of dependents also participating.
Absolutely.
We are looking at perhaps housewives also taking money out of out of their almirahs, or selling the family heirloom and using that to make investments, which is going to give returns perhaps higher than gold. Gold is no longer, you know, the safe haven for investments, which acts as a hedge against any sort of fluctuations. That was the case 30 years ago, not anymore. So I think what I can place this or attribute this to is that it is not just the earning member alone which is contributing, but it's also the non-earning members, leading to 8 CR, but 5 CR households where at least one taxpayer justifies, you know, these numbers.
Absolutely. So you have the housewives, or the house husbands rather, people who are not earning so much and who are dependent on the earning. Dependents,
you know, 18 plus children between 18 to 22, first jobbers, etc., in an informal capacity, also investing.
Absolutely, and getting robust returns there. Markets beating a lot of returns, a lot of other financial assets at this point in time. So more and more unique investors as far as Nifty is concerned. But moving on to a story that came out yesterday, and which is by the way of India's balance of payment, or the CAD, current account deficit, that is widened at least sequentially quarter on quarter.
Yeah, so that's what, Shweta, I think, the story is positive when you look at it. The CAD narrowing on a year-to-year basis from about $18 billion, it has narrowed to about $9 billion for Q1 of last year versus Q1 of this year. So you see narrowing on a year-on-year basis, but you see a widening on a sequential quarter-on-quarter basis. Now, what do we attribute this to? I think this widening on a quarter-to-quarter basis has happened on account of trade deficit widening, on account of remittances from abroad reducing, and the surplus that we enjoyed on net services, whether it was IT-linked service exports or or whether it was services of any kind. We've seen that while services happen to be in the surplus and manufacturing in the deficit in India's recent history, in fact more than recent history, we've seen that that trade deficit and surplus that we would get on account of services exports has reduced, and that is something that I think got reflected in the quarterly earnings of the IT sector companies as well. That discretionary spending by giants in the US who give business to India's IT companies had shrunk, and that got reflected in the CAD on a sequential basis narrowing as well. Now, what is this really leading to? I think what we are trying to arrive at is that by the end of this year, the financial year closing FY24 will see CAD staying pretty much in line of about 2 to 2.1% of the GDP. So when you look at the numerical value of current account deficit would balloon from about $60 billion or so last year to about, or $63 billion last year to about $75 billion by the end of this financial year. But as a percentage of GDP, remember GDP is also growing. So while the absolute number grows, as a percentage of the GDP, we are likely to be in a comfortable range of about 2% or so.
All right, so nothing much to worry there.
So mixed cues, like I said, there is going to be pressure on the INR because of this widening on a quarterly basis. So, the demand for purchasing rupees internationally would be lowered. So there is going to be pressure on the INR. Oil prices rising, not going to aid any economy, not India definitely. So that is going to be something which is going to further add pressure on the current account deficit. But then we are also seeing GDP growth numbers adding up. So overall, you are seeing manufacturing activity picking up. You will see hopefully a better agriculture season. You will start seeing export of rice restart hopefully in the month of October.
Yes.
So all of those export items, and even despite inflation in US, we've seen that that the US Fed has paused its rate hike cycle. If that were to continue, we will see more capital
Demand.
being more money available in the hands of corporates in the US, and some sort of spending to open up again for the Indian IT
All right,
sector.
and in fact, various Indian ministers have reiterated, including Piyush Goyal, that exports will pick up. Is there an indication there the exports are picking up, Suyash?
I mean, across various sectors, we have seen exports picking up, of course, on a year-on-year basis. But I also want to talk about this deficit situation. Now, India's fiscal situation will come under scanner because, the recent inclusion into India of government bonds into the JP Morgan index. Now, currently, the foreign participation in Indian bonds stands at about 2% or so. After the inclusion, it will jump up to 4%. Now, FTSE is also expected to include Indian bonds in its index. It has a AUM of about $1,400 billion or so. And then Bloomberg is also expected to follow. So, and India's fiscal deficit currently stands, the highest in terms of in relation with GDP among the 20 countries that are tracked by Bloomberg.
Okay.
So I think the fiscal situation will need to be monitored because that, the increased exposure to global events, because if foreign investors scrutiny will definitely increase to Indian markets. So this is a number that certainly the government would need to manage.
Absolutely right. But I think this inclusion in various debt instruments, bond is going to only happen in the next financial year, right? So I think this year the CAD story at about 2% of the GDP should not be a cause of concern. I think what this will eventually need to bolster is more manufacturing happening in India, more capital investments by private sector coming in India, and the consumption story staying robust. If these three are managed well, I think our fiscal situation should also be under control, and whatever surplus we get by way of investments through debt instruments into Indian bond markets, I think is only going to further shore up the rupee, which may be under pressure because of the vagaries of oil prices, etc.
All right, and rupee being under pressure, perhaps another currency, and our currency of our neighbor, Pakistani rupee, that's also in the news.
Yes, I think we've seen that the Pakistani rupee has been I think the strongest currency in the month of September, up about 6%. But I think to put it in perspective, Pakistan has had economic crisis of its own and has been reeling under inflation, government changes, and overall being in this debt trap that it's unable to repay, and really going pretty much with a begging bowl to the multilateral development banks, seeking capital infusion, funds, borrowing, loans, etc., to keep the economy afloat. So put it more in perspective, the Pakistani rupee, is at about a 30% valuation of the Indian rupee.
Okay.
So 1 rupee, or sort of one Pakistani rupee, is equal to about 0.29 Indian rupees. So 1 rupee can get you a little more than 3 Pakistani rupees. So the currency, of course, is deeply under pressure, and obviously because of the economic situation, volatility in the Pakistani currency is high. And a 6% increase, yeah, it's done better than the rest of the pack. And
why is it picked up?
So I think one of the core reasons is that the new Pakistan government is doing a crackdown on illegal trade using the dollar.
Okay.
So broadly, that seems to be the story coming out. Don't have the details yet, because illegal trade with dollar would actually mean that there are Pakistanis hoarding dollars and using those to make payments. And if they're hoarding dollars, they're selling Pakistani rupees to buy dollars, and that should actually weaken the currency. But here we are seeing a case of the Pakistani rupee strengthening.
Okay, which means the government
is
cracking down.
There is a crackdown of what kind, we don't know. So is there illegal purchase of Pakistan rupee happening by way of USD coming in? Perhaps seems like a logical reasoning, but don't have the details for that yet.
All right, don't have the details, but good news there, at least for Pakistan, at least for now. In the month gone by, Pakistani rupee up about 6 to 8% in the month of September, and the news coming on the back of an economic slowdown, struggles with the economy, job losses, rising oil prices, and Pakistan, of course, continues to battle all of that. We've run out of time on this bulletin. Thank you very much for watching.
When a patient's mother touches my feet, begging to save her child's life, I don't feel empowered. I feel humiliated.
To normal people, the doctor is somewhere in between us and the God.
I'm just an instrument in the hands of God.
What you have initiated in making healthcare affordable to Indians.
India will become the first country in the world to dissociate healthcare from affluence.
To do the right thing, there's only one reason needed, which is intent.
We are pieces to solve all the problems. Someone has to put it together. This is the story of India.
Duologue with Barun Das, featuring Dr. Devi Shetty. World premiere on Connected TV. Tonight at 10. Only on Newsline Live. India's first and only digital exclusive English news stream for Connected TV. Powered by Tata 1MG Labs. Supported by Alliance Broadband.